Welcome to our deep dive into the historical perspective of mean reversion in S&P 500 valuations. In the world of finance, few concepts are as powerful, yet as frequently ignored during bull markets, as mean reversion. It is the statistical phenomenon suggesting that asset prices and historical returns eventually return to their long-term average or mean. Think of it as financial gravity. When the S&P 500 valuations stretch too far from their historical norms, a correction usually follows to bring them back in line. Today, we will examine over a century of market data to see how this rubber band effect has shaped the fortunes of investors and why understanding these cycles is critical for long-term success. To understand where we are, we must look at where we have been. The cyclically adjusted price-to-earnings ratio, or Shiller PE, is our primary yardstick. Unlike a standard PE ratio, it uses inflation-adjusted earnings from the previous 10 years to smooth out short-term fluctuations. Historically, the median Shiller PE for the S&P 500 sits at approximately 17.06. When the ratio climbs significantly above this 17.06 mark, it signals that the market is becoming expensive relative to its earning power. History shows that whenever we reach these nosebleed levels, the subsequent 10-year returns tend to be much lower as the market eventually reverts to its long-term historical mean. History is punctuated by moments of extreme valuation. Look at the three most prominent peaks: the 1929 crash, the 2000 dot-com bubble, and the post-pandemic surge in 2021. In 2000, the Shiller PE hit an all-time high of roughly 44.19, more than double its historical average. Conversely, during the Great Depression, valuations plummeted to a PE of around 4.78. These extremes represent the overshooting phase of mean reversion. Markets rarely stop exactly at the mean. They often crash right through it, moving from euphoric overvaluation to despondent undervaluation before the cycle begins anew. These swings demonstrate that the further the market drifts from 17.06, the more violent the eventual reversion tends to be. What actually causes the S&P 500 to revert to its mean? Two primary engines drive this process: corporate earnings and interest rates. When valuations are high, it often assumes that earnings will grow at unsustainable rates. When reality sets in and earnings growth slows, or margins contract from record highs of 12–13%, the P in the PE ratio must fall to compensate. Furthermore, interest rates act like gravity on stock prices. As the Federal Reserve raises rates to combat inflation, the discounted value of future cash flows decreases, forcing PE multiples to compress. This interaction between the 10-year Treasury yield and corporate profitability is what ultimately pulls the S&P 500 back toward its historical valuation baseline. One of the biggest mistakes investors make is using mean reversion as a short-term market timing tool. While valuations are a great predictor of returns over a 7 to 10-year horizon, they are notoriously poor at predicting what will happen next month or even next year. The S&P 500 can remain overvalued for years, as it did in the late 1990s. This is often called irrational exuberance. An investor who exited the market in 1996 because the PE passed the historical mean of 17 would have missed the massive gains of the late 90s. Mean reversion is a slow-moving tide, not a sudden wave. It tells us about the climate of the market, not today's weather. Inflation is the hidden hand that alters the mean reversion landscape. Historically, periods of high inflation, like the 1970s, lead to significantly lower PE multiples. When inflation averaged over 6% in that decade, the S&P 500 PE ratio often sat in the single digits, well below the 17.06 average. This occurs because inflation erodes the real value of future earnings and pushes interest rates higher. Conversely, in low inflation environments, investors are often willing to pay a premium for stocks, allowing the mean to appear higher for a duration. Understanding the current inflationary regime is essential for determining whether the S&P 500 is likely to revert to its historical mean quickly or linger at current levels. How should a savvy investor use this historical perspective? The key is not to panic sell, but to adjust expectations and rebalance. When the S&P 500 Shiller PE is in the top 10% of historical readings, as it has been recently, It is a signal to perhaps trim equity exposure and look for value in other asset classes that are below their own means. This is the essence of buying low and selling high. By rebalancing back to your target allocation after a period of extreme market growth, you are effectively selling the overshoot and protecting yourself from the eventual reversion. Remember, the goal isn't to beat the mean, but to avoid being crushed by it when the cycle turns. In conclusion, mean reversion in S&P 500 valuations is not just a theory, it is a historical reality supported by over 1 century of data. While the new era, or "this time is different" narratives often emerge during bull markets, the fundamentals eventually win out. Whether it takes months or years, the S&P 500 has a relentless tendency to return to its historical median PE of 17.06. By keeping this historical perspective in mind, you can navigate market volatility with a cooler head, recognizing that extremes are temporary and the mean is the ultimate destination. Thank you for joining us in exploring the gravity of the markets. Stay disciplined, watch the valuations, and always respect the mean.